Good morning and welcome back to Almus Market Morning News. As the weekend was approaching, a few reports on attacks by Iran on commercial ships and subsequent retaliation by US on Iranian military surveillance, air defense, and drone storage sites threatened to shake the fragile ceasefire. But just like always, as Monday approached, both parties agreed to stop the attacking and resume the peace talks. For risk assets, thoughts of lasting peace and AI narrative have driven things so far. The key things to watch would be would either one of them, if they shake, then that would be quite negative for the risk assets, and for the dollar, of course, it's been the expectation of rate hikes by the Fed. Good morning, JK. We start another week on the brink of breaking MoU between Iran and US. How are you reading these things?
Good morning, Swaraj. Yeah, I think yes, these occasional incidents will keep happening because, as we know, in Iran there are multiple fronts of view arriving at this peace. So it's not just signed with the Iranian government and it's all over. Because there are other factions who also keep acting with their own context. So these things are to be expected. Important thing that the market and the world will be looking at is whether the shipment route is affected or it is closed or something. So but I think even in this incident there was no mention about Iran closing the strait or affecting the ship movement. So that was a good thing. And of course, both also have a need right now to honor this MOU, for the time being, because Iran is wanting these financial support and frozen assets to be released and sanctions to be removed also, which US has done for 60 days. So these and at the same time, US wants the strait to be remaining open and then oil prices to remain lower. So these are compulsions for both the sides to ensure that there is no major escalation. And in fact, in another relieving development, Israel, Lebanon, and US also reached initial trilateral framework agreement aimed at paving the way for ending the conflict between the two countries and ultimately reaching a peace settlement as well. So, all in all, I think I'm treating it as one more incident, and these such incidents could well happen again. Oil price has not reacted much. It is still trading somewhat below the level that was seen just prior to the war. On last week, of course, the inflation was in focus, particularly in the US, and the PCE inflation year on year rose to 2.4% from 2.3%. And the 6-month analyst pace has also climbed to 2.5% in May. Uh, See, these were actually expected on expected lines, I mean, but what is important is that it is PC is yet to fully reflect the impact of war-related inflation, as there has not been a full pass-through of the wholesale prices to the retail prices. And market did react positively to this data, along with the price of oil coming down, and the general expectation that inflation can come down further. But the inflation story has many more sides to it. See, the emerging source of structural inflation is the massive AI infrastructure build out and surging investment data centers, the price of semiconductors and chips, which are surging and pushing up the costs for these companies. And of course, the biggest thing is the electricity charges, which are expected to rise around 6% annually in 2026 and 27, potentially adding persistent inflationary pressures. And these are outside the oil related inflation pressures, and these could mean that structurally inflation is on the higher side. In fact, US trade deficit, good trade deficit for May also came much higher than expected, because the imported cost of the chips and semiconductors was much higher, and US does depend upon some of these products as well. So we have seen Apple announce a 15 to 25% increase in their products. Microsoft also announced a global increase in their products. So the inflation has many other facets where we have to look at apart from oil, and that is where the market can have some surprise. Inflation remains elevated yields does not go down, and the expectation of a rate hike by the Fed will also sustain. So that's something that one should be mindful of. We also had the US GDP data for Q1, the final estimate, which showed it went up to 2.1% from the earlier estimate of 1.6%. But this was driven mainly by a big fall in the imports, in the month of May, but this is a temporary factor, and could well be reversed in the coming days. Also, as the import prices are going up, and US needs a lot of these electronic components that from the outside of US. So this deficit is this trade deficit going up, going up will also sustain. Then US dollar has somewhat softened last week due to oil prices coming down. Yields, in fact, came down by 15 basis points. 2-year and 10-year and 30-year also came down by 12 to 30 basis points. But not really threatening the recent upside break in the dollar index, which broke the 100.50 after more than a year, and is well trading above 101 still. So there's some more upside potential to the dollar because the expectation of rate hikes in the US is sustained. We might well have US euro have a potential target at 1.12. So long as dollar index does not go below 100.50, these are valid. And the dollar yen is perilously close to its 40-year high. In fact, on Friday, it had its highest closing since 40 years at 161.76. Market is just biding time to break 162. There's no major intervention or talk of intervention from the BOJ authorities. So if so long as the dollar yen keeps going up, along with the broad dollar going up, the authorities may be somewhat reluctant to intervene as well. Otherwise, you can see the Chinese yuan is also somewhat correcting its steep fall, of more than 3.5% over the last 1 year. And this is also driven by the US yields increasing. Indian markets are somewhat delinked from the global markets, both on the currency and the equity. Equity, because most of the fall in the global equities are happening on the AI sector, and India is much less, composed in terms of the composition of the market. AI is a very, very small segment, and there is no major play that is being done in India as an investment as well as on the market side. So, but it doesn't mean that India has been rallying. It's still holding on to the recent ranges. It's not actually you don't see the big fall, the kind of fall that we're seeing in Korea or the Nasdaq, which all seem very quite bearish now. If you look at the Philadelphia Semiconductor Index, it is dropped 10% in last 1 week, and gives a very bearish picture as well. And other area where India is slightly dealing or performing the global markets is the currency, where dollar index has also gone up, but the rupee still holds on to the range. We have had 2 weeks of decent FII flows. Totally in the last 2 weeks, you've seen about 4 billion of inflows. Most of it, of course, were for the bond market, because that's where the government has really relaxed the tax rules for FIIs. So that could actually be continuing. Now that the oil prices also come down, the yields can remain attractive in India. Technically, we have, this month's close in the USD INR will be very crucial. If we do close below 94, then it could open up a lot more on the downside, because technical formation on the monthly charts indicates that a break below 94 is going to draw in more sellers in the USD. But of course, we have the next 2 days towards the month end, where we could see some elevated demand. But we'll again see how it closes tomorrow for the month. Thank you.
Thank you, JK. And just quickly summarizing, I think for dollar rupee, we are approaching the month end and also the quarter end, so there could be some sort of elevated dollar demand. But I think we have been sort of dealing when it comes to both equities and the currency side. On the equity side, we never participated in the AI rally, and we are not falling as indices and stocks are falling, especially on the AI related sector globally. So we remain rangy on the Indian equity side. On the rupee side, we are seeing a tendency to strengthen. Good amount of flows are coming into bonds now. But closing below 94 for USD INR will be very crucial, and that can open further downside. The dollar index continues to trade above 101 comfortably. Dollar JPY, 162 has held up till now, but it's very rangy and in a very narrow range and on the weaker side. So feels like it can either get a strong bout of intervention or it can break on the upside very. A big move can be sort of expected over there. But apart from that, yes, the fighting has subsided. Both sides do have the incentive to maintain the MoU. Uh, and when it comes to the entire inflation picture, we are not out of the woods yet because there's a lot of semiconductor chip prices have gone up, and that's seen a subsequent rise in the price of electronics globally, not just in the US. So we'll keep tracking all these narratives. That's it from us today. Thanks for listening. We will catch up tomorrow with a fresh round of updates.